to all traders, and thank you for joining me once again on our ultimate trading course. At the moment, we're on the beginner stage. We're going to go to intermediate and advanced. We go from beginner to pro, basically, in 9 easy steps. So today we're looking at important calculations in forex trading. So what I want to bring to you is, if I just put up the MT4 screen quickly, what I want to bring to you at the moment is the fact that we can see if we open a trade. I'll just open a live trade for you quickly at the moment, just so just open a very small trade. What all the significance is in opening a trade and what we are looking for. So we're looking for equity, margin, free margin, margin level, the profit and loss, where the best place to open and close a trade is, and also pending orders. So the whole point of this series is to get traders such as yourself in the know-how for the best ways to make some profits in the market, and also how to, most importantly, avoid losses as well. So because this is a live webinar, feel free at any moment to ask me any questions as we go on this presentation. So once again, thank you very much for joining me, and let's get into it. So we are on at the moment, as I said, important calculations of forex trading. My name is David Kindley. Thank you very much for joining me. So as I said, we're going to look at margin, equity, free margin, margin level, calculating the profit and loss, leverage, pit values, swaps, and pending orders. So any of this terminology that you are not getting for the first time, if you are missing something, feel free to ask me. As I said, this is a live webinar, so it's easier for us to get to grips with it and to talk about anything that you have any questions with, and anything that you want to be clarified as well. So because I just opened a trade, we are looking at margin requirement at the moment. So what is margin requirement? Basically, margin requirement is the amount of funds in your account that you need to open a particular trade. Now, I've opened a very small 0.01 lot of euro dollar. Now, we'll get into lot sizes and prices shortly, but this is what we are looking at the moment. So if we go back to our presentation, so like I said, the margin requirement is based on the volume, which is the size of the order, the leverage amount, and the instrument that you're trading on. So I traded on a euro dollar, and I did a 0.01 lot, but this is the example is on a 1 lot with a 1 to 500 leverage. Now, what we need to understand with lot amounts is that this means volume as well. So 1 lot equals 100,000 value in units of that particular currency. So if we take this example at the moment, we've got, if the euro dollar price was at 1.12862, we multiply it by 100,000, which is 1 lot, and then we divide it by the leverage, which is 500. So this will mean that it's $225.72. If we go to our live example, I'll just get my calculator out. It's always handy and trusty to have a calculator at hand. So the price at the moment is 1.00135, which is the price I opened it at. Okay, then we need to multiply it by the size of the trade. Now, this is a 0.01. So what we need to understand, and I'll just take you through this live. As I said, this is all bespoke and live for you, so we're not avoiding any miscommunication. So 1 lot equals 100,000 of value. If we go to 0.10, this equals 10,000, and the lot size that I just opened now equals 1,000. So because of that, we're going to multiply by 1,000. And why is this? Because my lot size is 0.01. If we've got a 0.02 amount, it's 2,000 that we need to multiply by. And if we've got 0.03, you guessed it, it's going to be 3,000. So this is how the lot amount works. For this example here, if we've got 0.20, it's going to equal 20,000. So these are the calculations that we need to consider. Again, if we've got 2 lots, this is going to equal 200,000. So this is all based on the calculations that we go through. And this is the volume size here. So I've got 0.01, which is what I'm going to highlight here. Just move that. So 0.01, so times 1,000. And then depending on your leverage, my leverage is at 500 at the moment. So as you can see, my margin requirement is $2 because it hasn't obviously kept on putting decimal digits on for that more afterwards. So this is the whole point. So if we take, and the leverage is very important to understand, which we'll get into leverage shortly, but to view your leverage, just open the navigator bar, and I've got all my demos here. And as you can see here, where it says demo 3050 USD, this is my balance. It's got the leverage next to it. So this is $5,000 and this is $4,971. But as you can see, the 1 to 500 leverage is there. So that's the leverage amount that I'm using at the moment for this particular account. If we close this order, and if I open another, so let's go 0.10. So we've gone a little bit higher this time. So based on that, I've gone on this example now. So let's just unhide that. So it's a bit easier to know. So let's do the calculation again. So as you can see here, my margin requirement has increased. So it's $20.03 now. So the price I opened it at was 1.00129. Then we're going to multiply this by 10,000 and then divide the leverage. So 500. So it's $20.02. And here it's $20.03, but as you can see, it's rounded it up to 3 cents here because the next digit is higher, is 5 or above. And let's open a one lot. So this is 100,000 notional value of that currency. And as you can imagine, it is actually getting more and more. As you can see here, it's $200 now. And why is this? Well, it's because the notional value or the lot size is a lot more. So 1.00135, which is the price I opened it at, multiply by 100,000 and then divide by 500. So $200.27. So there's no extra decimal here. It's just basically rounded at $200.27. So this is the margin requirement. Now, the platform or the MT4 terminal isn't taking these funds from your account. All you need is collateral to open the trade. So you need to just have that in your balance to make sure you can actually open the trade. And why is this? Well, it all actually has an effect on the free margin and the margin level, which we'll look at now. As I said, any questions you have as we go forward, please let me know. So, as I said, I was giving this example, trading with smaller lot sizes means that margin requirement will also be smaller as well. So this is just basically making sure that you as a trader, you're not opening more volume or notional value than you need to in your trade. So the equity, what is the equity? Well, let's just go back to the screen here. So equity at the moment, I've got 4,942. So as you can see, it's a little bit less than the balance that I started with. And why is this? Well, because the equity is your balance plus or minus your open profit and loss. So at the moment, I've got, we'll do, as I said, we'll do this all live, and any questions you have, let me know. So 4,969.24, that's my balance. And I'm going to minus $27 because that's what I'm in negative at the moment. So 4,942.24. As you can see here, so basically it's your balance plus or minus your profit and loss. If I was profitable $27, then 4,969.24, and then I'll be plussing 27. So my equity will actually be almost $5,000. So 4,996.24. This is what my equity would be if I was in a profitable position. And as you can see, we are moving up and down a little bit at the moment. So that's why the equity will move with the profit and loss as well. So as we go up and down on the profit and loss, we will be going up and down with the equity as well. Because the market is a little bit slow at the moment, because it's the evening session and we're coming into the the second half of the American session at the moment. As you can see, there's not much movement, but as you can, it is actually still moving slightly, but just not as much as it would do in the European and American early session. So that's what equity is. So moving on, we've got free margin and margin level. So free margin, the calculation for free margin is your equity minus the margin equals the free margin. So this is the amount available to open more new trades. If there's not enough free funds in the account to open more trades, then the message not enough money will appear. So let me open a huge trade that I know I won't have enough money for. Let's open 50 lots, which is obviously 5 million notional value. And I'm going to get not enough money because I just don't have enough. So why do I not have enough? Well, The notional value is 5 million if I want to open 50 lots. So that's 5 million. Then we multiply it by the price. At the moment, it's 1.00135. And then we divide it by 500, which is my leverage. So I would need just over $10,000 to open that particular trade. As you can see at the moment, my equity is just below $5,000. That's the reason I'm getting that particular message, not enough money. So that will tell you if you don't have enough funds in your trading account, this is the reason why you will get this particular message. So going back to free margin, the free margin. So equity minus the margin equals your free margin. So at the moment, we've got the equity minus the margin. So it would be 4933. Let's go again. So 49. Oh, I'm making more of a loss now. Minus 200.27. So we've got 4781.97. Because the market is moving slightly, that's why it's a little bit off. So basically, your free margin is your equity minus the margin will equal your particular free margin level. And again, this is why your free margin will move as well with your profit and loss. So I was on minus 41. I was on minus 27 as well, but now it's fluctuating higher and lower. So this is the reason why we are getting the moves. So that's why. And it all adds up to your margin level. Now, your margin level is very important. I'll just show you the quick calculation. So it's your equity divided by your margin and then multiplied by 100, because we multiply by 100 to get a percentage. So your equity at the moment, or my equity at the moment, 4929.24, divided by 200.27, and then we multiply by 100. So because the market is moving slightly, that's why my number is slightly off, but 246130. So it's rounded it up because we've got 29.7. So for argument's sake, that's the calculation. But what's most important is the fact that if your margin level drops to 100, then you get a margin call. Now, what a margin call means is that you have a slight warning on your platform to say that your funds will be dangerously low and you'll be in the dangerous scenario that you will be stopped out. Now, what is stop out? Stop out is when your account gets to 20% and your most heavily traded, let me just open a couple more trades here. So let's just do pound dollar. We won't do 50 lots because I can't actually do that. So as you can see, my margin level is dropping and dropping with the trades that I'm opening. And if this gets to 20%, it's going to close my most heavily negative trades. So for that case, if I got to 20% of my margin level, it would first close this trade because it's more in a negative than the other two. And obviously, if I close this trade, let's see what happens to my margin level now. We've gone up from 724% to 1137%. And again, if I close another trade, which is my most heaviest negative, there we go, 2127. So this is the whole philosophy of why traders need to understand what trades to really focus on and make sure that you are not putting your balance and your equity at risk. Because even though I've got nearly $5,000 in my demo account, it doesn't mean that I'm not going to get stopped out. As you can see before, my margin level dropped to just over 700%, and I only had 3 trades open. Imagine if I had 7 or 8 trades open, how my margin level would be. So these are just a few things that the trader just needs to understand, just to get in that psychological mindset of making sure that they're not putting too much emphasis on risk. And obviously, these are one lot trades. So if I close this, I can even open smaller trades, 0.10. And I can do that for each trade here. Let's just open a few trades. So now, again, because my lot size or my volume size is smaller, that means my loss will be smaller. And in doing so, my margin level will be a little bit healthier. As you can see here, it's just over 7,700%, which means that we are looking pretty healthy at the moment. But the moment I open a one lot trade, as you can see, we've dramatically fallen because you can see the size of the lot amount has pretty much doubled my loss because of the calculation. So we'll go into profit and loss calculation shortly. Actually, let's go into it now, so it's a little bit more easier to comprehend. So let's just take a screenshot of this, because I just want to show you what we're looking at the moment. So again, we need the trusty calculator, which is always helpful. So we've got euro dollar for this particular trade here. So let's do 1.00095, which was the rate. Then we're going to multiply by 10,000 because that's 0.01. If you remember from the beginning of the presentation, 0.01 is 10,000 notional value. So 10,000, and then divided by 500. So that's the margin level that I need. But if I go to one lot, so remember $20, but if I go to one lot now on this particular trade here, we've got 1.00100 multiplied by 100,000 and then divided by 500. So as you can see, it's pretty much really quadrupled really to $200 margin level. Now, if we put that into terms of profit and loss, the way we calculate profit and loss is we take the opening price and the difference with the current price, and every symbol, euro, be it euro dollar, dollar Swiss franc, pound dollar, has a different value. I will go through the values shortly, but what we do here is, as you can see here, we're in a loss, pretty much the same open price, and the current price is the same. But as you can see here, this is $1.60 that I'm in a negative, and this is $21. The reason of this is because of the volume amount, which we'll go into right now. And as I said, any questions, please feel free to ask. So we're looking at pips and points. Now, what is a pip and what is a point? So a pip is quoted as the fourth and fifth digit in most forex pairs. And in Japanese pairs, it's quoted as the second and third digits. So let's just take an easy example. So for euro dollar, it's the fourth digit for the pip. So after the digit 1, 2, 3, 4. So in this particular scenario, 1.12259, so the pip would be 5 or 59 points because the point is coming after, or it can be 5.9 pips or 59 points. So let's just take a live example here. So at the moment, again, let's freeze this so it's a bit easier to see. So the pip at the moment is 1.0009. So that's the fourth digit. So it would be 9.5 pips or 95 points. If we just stick with pips, it's a little bit easier to understand. On the pound dollar, it's 1.14196. Again, 9.6 pips. Dollar Swiss, 0.96534. So 3.4 pips. And euro dollar, at this other example, we haven't got any pips here. Well, we've got 100 pips, we could say, because the first digit is the point, the second digit is the pip, but 0, and the third digit would go into 100 pips, and the fourth, this digit here would be 1,000. So you could say here is 4,196 pips. But you get the general idea. But if you don't, please let me know. So because of this, it gets a little bit clouded now with the particular calculations. So let's just see what we're doing here. So pip values per one lot. If the dollar quote currency, if the dollar is a quote currency like here, it's $10 a pip. So this is how we calculate the profit and loss. So let's go back to our live example. So we've got euro dollar. For these two particular pairs, pound dollar and euro dollar. Just highlight these two so it's a bit easy to see. So per one lot equals $10 a pip. I hope you like my writing. Please don't comment on that. So at the moment, we've got 9.5 pips on this particular trade. So I'm going to get the trusty calculator out. Move it to this side. So we've got 1.00095 minus the current open price, 1.00078. So it's this price minus this price equals 0.00017. So the difference between the open price and the current price here is 1.7 pips. So 1.7, and we said per one lot, it's $10. But this is 0.1 lot. So this will mean that it's a bit less. So we then multiply by 0.10 and then multiply that by $10. Now, the reason I multiply it by $10 is because for every one lot, it's $10. So in this particular instance, we did 1.00095 minus 1.00078. So 1.7 pips difference. Multiply that by the volume amount, which is 0.10. And then we multiply that by 10. Sorry, 1.7. 1.7 multiplied by the lot amount and then multiplied by 10. So this is because every quote currency that's in dollar is $10 a pip, and this is standard. So let's try it for the pound dollar. So we need the difference between this price and this price, which is 1.14196, and then minus 1.14167. So 2.9 pips, because 1, 2, 3, 4, so it's the fourth digit, and then we've got 9 as well. So 2.9 pips. 2.9 multiplied by $10 because the pound dollar pip value is 10, and then multiply this by the volume size, which is 0.10. And there we go, $2.9. So that's my profit and loss. And that's how the P&L is calculated. Now, if we've got a currency that doesn't have $10 pip value, such as the dollar Swiss, as you can see here, let's pause this. So we've got, now let's do the same example and I'll show you why it's going to come out a bit wrong. So the difference first from the open price to the current price. So 0.96534 minus 0.96518. So 1, 2, 3, 4. So 1.6 pips. So 1.6 multiplied by the volume amount, which is 0.10, and then multiply that by $10. As you can see here, it's a little bit off because it's a different quote currency. It's not dollar on the second currency. It's Swiss francs. So what is the pip value for Swiss franc? Well, this is what we have to understand. For Swiss franc, it's $10 divided by the dollar Swiss franc rate. So what does that mean? To go back to the platform, so we've got $10 divided by 0.96523 approximately, because that's the rate at the moment. So we can see that for euro dollar and for pound dollar, the rate is, the pip value is always $10 fixed. For dollar Swiss, because we have a small calculation involved, at the moment it's $10.36. Okay, so remember this number $10.36 because so 0.96526 divided by 10. Sorry, no, it's 10 divided by that. 10 divided by 0.96530. So let's say 1035 approximately. So we're going to go for the open and close now. 0.96534 minus 96,518. So 1.6 pips, 1.6 multiplied by that, by the lot amount, and then multiplied by $10, approximately 26 cents. So that's why we have 1.64 at that particular moment, though it was probably a little bit higher, but you get the point. We have different pip values for different currencies, and this applies for each one. We'll do a few more examples. So for Japanese yen, we've got 1,000 divided by dollar yen, the dollar yen rate. For pound, we've got, it's always the same. So, no, sorry, for pound, it's 10 multiplied by the pound dollar rate. For Canadian dollar, it's 10 divided by dollar CAD. For Aussie, it's 10 multiplied by Aussie dollar, and you get the rest of the things. As I said, if you want any clarification on this, please let me know, but let's look for the next currency. So let's do a British pound one, which has the quote currency as pound. So let's close these so we are in more of a clearer picture. So euro pound, the quote currency there is pound. So let's open a one lot. Let's be a bit adventurous. So let's put this on. Let's freeze this so we can see the P&L and get our trusty calculator out. So we've got 0.87661 minus 0.87630. So here, 3.1 pips. Okay, nice and easy. So 3.1 pips multiplied by 1, because that's our volume, equals 3.1. Now, as you can see here, the difference is 35.40, which is a very big difference. But why is this happening? Well, we can see because the pound dollar rate at the calculation is 10 multiplied by the pound dollar rate. So let's see how that's working. So 10 multiplied, and what is the pound dollar rate? 1.14157. So as you can see here, it's over $11 a pip, which is obviously more than the euro dollar, because that was $10 a pip. And the dollar Swiss franc was $10.26. So if we keep that in mind, $11.41. So let's see now from our example here. So 0.87661 minus 0.87630 equals 3.1 pips. So 3.1, multiply that by the pip amount, which was approximately 11.40, let's say, and then multiply that by 1, which is the lot amount, and 35.40. Okay, we got a little bit off because probably the price here is a bit different from my market watch, but that's how we calculate the pound, well, the quote pairs with the pound on it. So this gives you a sense that at the moment you could think, well, the pound dollar, the pound pip value is more than the dollar or the Swiss franc. So this could be more beneficial for me. The pound dollar at the moment is obviously pip value is more, it's $11.40, whereas dollar is $10 round. And depending on the currency of the dollar Swiss or dollar yen, this is giving me the next amount of the pip value. So it's all about pip values when you're calculating P&L, and obviously it's all about pip values when you're looking for that next trade. So let's just do one more. Let's just do Japanese yen, because this is a different kind of currency, because as you can see here, most of the currencies have 5 digits after the decimal point, but Japanese yen only has 3. And this is because the pip value is the second digit after the decimal point. So let's just do a dollar yen trade. Let's do something a bit more different. Let's do 0.50 lots. And let's freeze this so that we can see it a bit easier. So we've got 9.43. So currently, the current pip value is 1,000 divided by the dollar yen rate. So what's the dollar yen rate? 143.20 approximately. So the trusty calculator comes out again. So 143.201 and divide that by 1,000. I beg your pardon, it's 1,000, sorry, divided by 143.20. So each pip value, as you can see here, it's a lot less than $10. It's roughly about 6.9. You could say $7 to round it up to make it a bit easier. So it's a lot less than $10 and a lot less than the pound pip value, which was $11.24. So bear that in mind. So $7, it's a little bit easier to remember. So 143.22, which is my open price, minus 143.20. So I've got 2 pips. And why is this 2 pips? Well, as I said, after the decimal point, it's the second digit with Japanese pairs. So this is just something to remember for Japanese pairs. So I've got 2 multiplied by 7, which was the pip value, and then multiplied by the volume size, which is 0.50, as you can see here, equals 7. So that was roughly what I was paying at the moment. So let's just do this live one here. So it's a bit easier. 143.228 minus 143.201. So 2.7 pips, 2.7, and then we multiply by the volume, which was 0.50, and then multiply that roughly by 7. So 9.45, here we've got 9.43. As I said, it's a rough one because it was just below $7. It was 7.69 something. So as you can see, with Japanese yen pairs, this is how we calculate the profit and loss. So each currency pair that you're trading on has a different calculation for the lot amount. The easiest one to calculate is the ones ending in dollar, because these are $10 per lot fixed. These will never change. So if we open Australian dollar against American dollar, this is going to be $10 per lot. If we open New Zealand dollar against American dollar, this is $10 per lot. Let's just put this as 0.80, just to give it a little bit more diversity. So this is very easy because this is always $10. There's no extra calculation like we did before with the Swiss franc or the Japanese yen. So let's just get the differences. So the Australian dollar, we want the difference between this and this. So 0.67134 minus 0.67113. So 2.1 pips, as you can see here, 2.1 pips multiplied by 0.50, which is the volume amount for this particular one. And then we multiply that by 10. And as you can see here, 10.5. And even though we are trading a different currency for the New Zealand dollar, the quote currency is the American dollar. So it's always the same. So again, 0.59507, which is the open price, minus 0.59484. And that leads us to 2.3 pips, right? So 2.3 multiply by 0.8 this time, because we've got a different volume size, and then multiply that by 10, 18.4. As you can see here, 18.4. So just bear in mind that each currency has a different pip value. The easiest ones to calculate are dollar yen. The ones with the dollar pairs on the end, which is the quote currency. And for everything else, Canada, Japanese yen, Swiss franc, they all have a different calculation. And if you give me your email addresses at the end, I can send you these calculations as well, just to give you a little bit of a head start, so you're not missing anything if you're trying to calculate a profit and loss and wondering why you're getting different values, because the dollar quote currency is $10 and let's say the New Zealand dollar currency is a different calculation. So this is the whole emphasis on pip values. And as I said, please feel free to let me know anything that you kind of uncertain about or anything else in the pip value scenario. So sorry, I had to see my face again. Let's go on to the next slide. So we just looked at calculating profit and loss. And as I said, For euro dollar, it's always $10 a pip fixed. Always remember that. For dollar CAD, as I said on a previous slide, we've got a slight calculation, but I'll go through that as well. So 10 divided by the dollar CAD rate, so it's $8 approximately. So as you can see, because of the amount of value of the currency, it could lead to you making that decision. Well, for example, I'm gonna possibly make a bit more money on trading a euro dollar trade because it's $10 a pip rather on the dollar Canadian dollar rate because it's only $8 a pip. So these are the things you just have to keep in mind when you are thinking of a trade, because it can give you another instinct into that clairvoyant, into that next decision that you're going to make. So moving on to swaps. Now, a swap is a fee charged overnight if you leave your trade open. And basically, this is just because the liquidity provider or the bank is actually charging the broker, such as Orbex, that particular overnight charge. So that's why there is sometimes a small fee applied. Now, what are these small fees? Well, if you go onto the Market Watch and right click and go to specification, you can see here the swap amounts. So swap long is for buy positions and swap short is for sell positions, and this is in points. Now I'll explain this to you shortly, but I just want you to know that you can go on any of these, and sometimes, actually most of the time, the swaps are in positive value as well as negative. So if you leave your trade open overnight, it's not necessarily a charge or a fee. You could actually make some funds on that particular trade. So just be careful to know what you're looking for. As I said, this has a positive, this has a negative because it's got a negative mark on it, but you can check on any particular currency to see sometimes they're both negative, sometimes they're both positive, and sometimes it's one-on-one. Like here, for example, so this is negative, positive and negative. This is for buy positions and this is for short positions. Now, how do we calculate swap? Well, swap, as I said, it is a particular charge, a positive or negative. Now the calculation is per one lot. So if you've got a 0.01 lot position open, you'll put 0.01 on your calculator. Pip value of the forex pair. So at the moment we can do this pretty easy. So from the examples we've just seen, so we do one lot. So we can do one pip value of the forex pair. So that's 10 for dollar, for euro dollar or any dollar quote currencies. And then we've got the number of, we'll skip to number of days. So let's say I left my trade open for 3 days. So we multiply it by 3. And then we look at what the value is for the MT4 specifications. So if we go back on here and go to dollar, New Zealand dollar, Japanese yen. This is in points. So what that means is we've got to take this decimal point and put it forward, put it to the left. So it'd be 0.3885. For this particular, we'll just move that away. So this particular trade, 0.3885, because it's in points. So it means that, as you can see here in points, that it says, so it means that it's not actually 3.885, it's 0.33885. So multiply by 0.3885. So if you left your trade open for 3 days on this particular trade, you will get a profit of $11.65. Conversely, if you left it open on a sell position, there would be a fee applied, a charge, because it's in a negative. So this is how the swap fees are applied for this particular, well, for in general for swap fees. It's just something that we're looking at the moment, and swaps are always a vital part of your trade because you don't want to wake up in the morning with your trade possibly in a positive or a negative and then have a swap fee here that you didn't know about. So this is how the swap fees are applied. So just go back again just to see a quick reminder. So this is per one lot multiplied by the pip value, the volume of the trade, and the number of days. And don't forget the MT4 specifications as well. So let's go through another example. So I've got Australian dollar against American dollar here. So let's go to the specifications. So I've actually got a buy position here. So the buy position here, swap long, is 1.376. So again, because it's in points, we move this decimal point here to the left. So it'll be 0.1376. So 0.1376, multiply that by 0.50, which is my volume size. Multiply that by 10, which is the pip value for the Australian dollar, New Zealand dollar. And let's say I left it open for 2 days. So I'd have a charge, because it's in a negative, of 1.376. And if we just divide that by 2 to get back to it, if I left it open for 5 days, then I'd have a charge of $3.44. And conversely, like I said, if it's in a positive, then you will actually receive that as a positive figure in your swap amount here. And let's just do New Zealand dollar, American dollar while we're on the subject. So I've got another buy position. So long position is minus 0.815, but we move this decimal point to the left, so it'll be 0.0815 multiplied by 10, because it's dollar, dollar, so that means it's $10 per pip. Multiply that by 0.8, because that's my volume amount. So that's per 1 day. So if I left it open for 2 weeks, which is 14 days, there would be a charge of $9.12 or 13 cents. I think it will round it up. So $9.13 on my swap. But as we said before, if you see this charge after 1 day, then you can consider your options and see if you want to keep this trade open, because obviously after 2 days, we're going to have $1.30 charge, because they're both in a minus, but it's a very, very small amount. As I said, because it's in points, we shift it to the left-hand side. So I hope that's very clear. As I said, any questions, please feel free to ask me. So coming to the next part of the presentation, we're just looking at order types now. I looked at this in the previous presentation that I did a couple of weeks ago, but just a few clients and a few traders just wanted to clear up what orders are, what type of orders are. Well, there's 2 types, basically, a pending order and a market order. What I've been showing you all presentation are market orders. This is when we go into the market, I open this and I buy, and this is an instant market order. This means my order's been opened in the market and it's actually trading at the moment. A pending order, however, is a order that we're going to wait for it to happen. So we're going to place it in the market, but we're not actually going to open it just yet. And there are 4 types of pending orders on the MT4 platform. They are buy stop, sell stop, buy limit, and sell limit. Now, what are the differences between this? Well, we're going to go through some live examples, first of all, shortly, sorry. But first of all, I just want to give you a brief demonstration on what these 4 orders are. So a buy stop basically means that the order is placed above the price line and it's expected to keep going. Now, what does that mean? Now, I like to give live examples. It's a lot easier to see because a lot of my clients, obviously, we like to see, to read what it's about, but it's better to see what it's about as well. So let's go down to a 15-minute chart, so it's a bit easier to see. And let's just do a couple of quick modifications here. So I'm going to be away from my office. I'm going to be away from the MT4 trading platform. I'm looking at the euro dollar chart at the moment. I'm thinking to myself, these are a couple of nice levels here. We've had a couple of peak here and a peak here. And I'm thinking to myself, well, maybe I think the price is going to start moving higher. And if we break this particular area, it's going to start moving higher. So because I'm going to be away from my PC, I'm going to put in a pending order. And the buy stop means that once the price hits here, I expect the price to keep on moving higher and it's going to open the order for me automatically. So roughly 1.1441. Let's get rid of this so it's a bit easier to see. I'm going to put in here. So this is the pound dollar chart. So pending order, buy stop. So 1.1488, I believe it was. And we're going to place it. Oh, it was a little bit less than that. Let's move it lower. So where did we say it was? We said 1.14418. Sorry, my mistake. So we're going to modify it 1.14418. Modify. So there we go. So now I believe that because I'm going to be away from my PC, this order is going to open and keep on moving higher. So that's what a buy stop is. We're in the process of buying and we expect there to be a stop and then push higher. So that's the whole point. Conversely, a sell stop works in the same way, but for a sell position. Now, again, I'm looking at the levels here and I'm thinking, okay, these are some nice levels. I believe that at this price, 1.1362, I'm going to be away from my PC. I think the price is going to go a little bit lower, break this particular area, and then start moving lower. So that's a sell stop. So let's just put that in as well. So pending order. So we're going to put a sell stop in, and it's at 1.13. Let's go 60, just a little bit lower than that. So as you can see here, that's where I believe my sell position will be accepted in the market. So this is the whole point of pending orders. It's when maybe you can't be at your desk or your office or your mobile application to open these trades. So you put them in and then you're in the hope that the market will go in your favor. Now, the thing that you just have to remember is a buy stop is placed above the line, the buy line, and the sell stop is placed below. Now, if I try to do the opposite way, put in a pending order and put the sell stop above or at the same price, because it's above the market price, it's going to give me invalid because I'm placing it above and it's incorrect. You can't place a sell position, a sell stop, sorry, above the bid line. And conversely, if you're trying to do a buy stop as well, it has to be above. So if we do 1.1360, which is below, it's going to give me invalid because I cannot place a buy stop below the bid line, the market price. It won't work. It's just incorrect. The buy stop has to be above and the sell stop has to be below. And this is why you're going to get invalid. So if you do see this message, it's most probably because it's the other way around. So I hope the stops are fine. Let's move on to limits. Limits are a little bit more tricky because they kind of contradict what we're just seeing now. They're kind of the opposite of what we're looking at the moment. Now let's close these two. By the way, because these are pending, they're not actually active in the market. If I put an active market order in, as you can see, my active market orders are above my equity line, my gray line here, and pending orders are below it. Just something to remember so that you can differentiate and separate them. So these are my pending orders and this is my live order in the market. So let's close all of them. You can just close it with the X and let's get rid of, no, let's leave them actually, because now the limits. So a limit basically works in the opposite way. So for a buy limit, the order is placed below the price line and is expected to bounce and retrace. Now, what does that mean? So what I'm looking at, actually, let's delete these, it's a bit easier. So a buy limit is basically, I think the market will start moving lower, get to a certain point, and then start moving higher. But at this certain point, I want my trade to open. So this is a buy limit. So a buy limit kind of works in the opposite way of a buy stop. However, you are still hoping that the market will move higher. So let's just see what that means. So pending order, buy limit, and I want it at 1.1375. Let's just get rid of this, it's easy to see. So 1.1375. So now I've placed my buy limit under the market line, but I am expecting it to get to a certain point. My my order will be open, and then I'll start moving higher. So that's the whole point of a buy limit. Conversely, a sell limit, I'm expecting the price to move higher, get to a certain point, and start moving lower. So let's delete these particular lines for the buy limit, because it can be a bit confusing. So the sell limit, I'm expecting from my market research that it's going to open at 114.89, and then it's going to start moving lower. So I've still got selling in mind, which is why it's called a sell limit. However, it's placed above the market line. So that's the only difference with the stops and the limits. So to reiterate, the stops are placed above and below. Buy stop above, sell stop below, but the limits are in the opposite direction. So let's place a sell limit just to show you live. So sell limit, and 1.14, let's say 90, it's just one pip above place, because I want to delete this red line. So that's what a sell limit is. We're expecting the price to move at a certain point. My trade will be open, and then I'm expecting the market to start moving lower, and then that will give me my sell limit. And again, because this works in the opposite way, if I try and open a buy limit that is above the market price, so let's say 1.1480, it's giving me invalid. And why is this? Because the buy limit has to be placed below the bid line, and conversely, the sell limit has to be placed above. So if I try and place the sell limit below, let's say 1.1348, again, invalid. So it's not giving me the option to open this particular trade because I've done it in the wrong way. So as I said, it's just important to remember, for stops, the order is placed above the price line and expected to keep going. So this is my price line. I'm expecting the market to start moving higher, open at this particular area, and start moving higher. And a sell stop, this is my bid line, the market line. I'm expected the market to move, hit my sell position, my price, open the pending order, and start moving lower. So this is clear for buy stops and sell stops. For a buy limit, however, I'm expecting the market to move a little bit lower, hit my pending order, and start moving higher. And for sell limits, I'm expecting the market to move higher, hit my pending order target, and then open, and then start moving lower. However, the limits have to be in the opposite direction to the price that you're opening them. So like I said, for a buy limit, we have to open below, because I'm expecting, in my own analysis, I'm expecting the price to start moving lower, open around this area, and then start moving higher. So eventually I'm buying. However, sell position, that's the theory anyway. Sell position, we move up a few pips, and then I'm expecting the market to collapse and start moving lower. Just move this so it's a bit easier to see. So that's the whole philosophy of pending orders and buying stops, limits, whatever we look at in the market. And as I said, those are the two types of pending orders. Market, which is instant. So I'm going to just go into the market here, open, and I've got an instant market order in the market, open, and it's live. And pending orders, which are basically a price that I think eventually the market will reach. And when the market is close, this tab will go green to indicate that we are close to opening this particular price at the moment. So I hope that's very clear. And that's the end of the presentation. So anything that you have, any questions that you might have, or if you want me to send you any information regarding this presentation with pip values, point values, pending orders, a lot of questions that I get asked on a daily basis from our clients and traders is, what are the best pending orders to place at these particular times? And also, what currency pairs have better pip values? Then these are the questions that you can ask me. So if you send me your email address, I can contact you directly via email and send you any information you want. So please feel free. I'll be online for a little while longer if you want to ask me any questions. And as I said, I'll be here for anything that you need. And join me in 2 weeks' time as I go into the next presentation for this series of presentations as we look at the ultimate trading course with the live webinars, as I said, hosted by myself, David Kindley. So the next one will be in 2 weeks' time. So feel free to join me then and ask any questions that you might have. So until then, thank you very much. Bye for now. And as I said, if you have any questions or you want me to send you any information via email, please feel free to share that and I will be able to send you any information that you might have. So as I said, have a great evening ahead and I'll see you in 2 weeks' time, and feel free to reach out to me if you need to. I'll be online for a little while longer, so feel free to ask me any questions you might have. So thank you very much and bye for now.